After finally moving past some early turmoil in 2024, this business seemed poised to resume its seemingly annual returns of at least 10%. But we close out 2024 the same way we began, with fear, uncertainty, and doubt. UnitedHealth Group has had a year it wants to forget for 2024. The first 6 months saw negative sentiment rule this stock after waves of negative events seemed to be reported every couple of weeks. But a stellar Q2 earnings release saw all of that turn around, shooting the stock up, and it seemed to be climbing ever since. Welcome to the Quality Investor. After hitting a 52-week low of $439.20 on April 12, 2024, UnitedHealth was certainly a dog of the S&P. It was down 16.6% on the year at that point and was dealing with cybersecurity attacks and DOJ investigations. But it started to recover and really started running after the Q2 earnings. It had its highest close of the year on November 11, 2024 at $625.25, a 42.4% increase from that low. Things were looking good. Year to date, it was up 18.8% at that point, and then it seemed to be poised for a big finish in 2024. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. A heinous act was committed the early morning of December 4th, shocking the nation. As the CEO of UnitedHealthcare, the insurance arm of UnitedHealth Group, walked briskly down a Manhattan street, a lone assassin stepped up and fatally shot Brian Thompson, calmly clearing gun jams in the process. A stunned onlooker fled the scene, and the gunman nonchalantly biked away. Murder is always wrong, and the defendant, if found guilty of this crime, should at minimum spend the rest of his life in prison. However, this attack, as atrocious as it was, is not the reason for the recent sell-off we've seen of the nation's largest health insurance company. While the stock actually rose the day of the assassination from $605.23 to $610.79, some panic did set in the following days. The stock slumped to $549.62 by December 6th, but it seemed to start its recovery afterwards, getting back to $565.19 on December 10th. It was what the U.S. Senate announced on December 11th that has caused the real sell-off of UnitedHealth Group. And not just UNH, but a whole slew of health insurance stocks as well. A bipartisan bill was introduced that would force health insurance businesses to sell off their allegedly much more profitable pharmacy arms, what are known as pharmacy benefit managers, or PBMs. This has sent UNH into a tailspin. UnitedHealth is down 11.5% since that announcement, and it seems like we have not yet reached the bottom. So today, I want to discuss this legislation and how it can potentially affect UnitedHealth. And after this potential thesis-altering event, is it time to sell my stake in this healthcare giant? New bipartisan legislation would force insurers, PBMs, to sell pharmacy businesses. It was this legislation that sent all of these healthcare stocks tumbling down. Essentially, there's a lot of consolidation going on right now in the healthcare market. In my deep dive on United Healthcare a few months ago, I explained how this consolidation worked. There's an insurance arm, which is United Healthcare, and then there's this second arm made up of doctors groups, an analytics business, and the PBM, also known as OptumRx. This second arm is called Optum. It's what's known as vertical integration. So see, you have United Health Group, their Optum arm, and then the United Healthcare arm. United Healthcare provides insurance. Optum Health is a series of doctor groups listed out right here. Optum Rx, that's the PBM. And notice it's one of three businesses within Optum, And then there's Optum Insight, which is the analytics group. You also see the competitors, CVS Health, which owns Aetna, and then you see this little arrow here to CVS Caremark. This is the PBM for CVS. And then we have Cigna, and this little arm goes to Express Scripts. This is Cigna's PBM. Of course, smaller players here, Humana with CenterWell, but the point is this is the vertical integration landscape. This is what this legislation aims to separate. They want to separate these PBMs, OptumRx, from the overall parent company, UnitedHealth Group. On Wednesday, Senators Elizabeth Warren and Josh Hawley introduced a bill to the Senate that would require healthcare companies that own health insurers or PBMs to sell pharmacy assets within 3 years. This is presented as a massive shakeup for U.S. pharmacy supply chain, cutting off revenue and market power for PBM giants and the conglomerates that own them. The legislation is touted as a direct benefit to independent pharmacies, which accuse PBMs of paying them less than in-house businesses for dispensing medication and directing patients away from their doors. However, according to this senior fellow at USC Brookings, Matt Fiedler, it's very unclear whether the fact that PBMs own pharmacies is good or bad for consumers on balance. Given that, it's unclear if forcing them to divest their pharmacies would be a good or bad on balance. Very vague, but the point is, a lot of this is up for debate. And as I'll show you here in a second, is this as profitable as the media makes it out to be? But the article also notes the real issue of this legislation, which continues Congress' recent habit of zeroing in on PBMs and not drug manufacturers as the main culprit behind skyrocketing drug prices. Now, I'm not going to sit here and pretend to know all the solutions to the healthcare issues the United States is facing. I don't. What I do know is that UnitedHealth is a very solid business that predictably grows its profits and thus is good for investors. What I do think, though, is let's say this legislation passes. I don't see how that will fundamentally address any of the real issues going on in the United States healthcare market. It hits a part of the issue here, skyrocketing drug prices, but anybody that understands pharmaceutical companies and how these drugs are developed understands that there's a very large R&D, research and development component going on inside of these pharmaceutical companies. They throw billions and billions of dollars to R&D, where only about 10-15% of their pharmaceutical concoctions actually come to market. So in order to recover those costs, they have to charge a very high price to realize any real benefit. Pharmaceutical companies are also granted 20-year patents when they do bring a new drug to the market. However, it's also known that these pharmaceutical companies charge far less overseas or even across the border in Canada for these same drugs than they do in the United States. To me, there's a lot of real issues going on here. This legislation addresses none of it. It just sounds good politically, which, if we're honest, is all that matters anymore in the United States Congress. This is touted as patients before monopolies, PBM. The industry is highly consolidated with just 3 PBMs, Caremark, Express Scripts, and OptumRx accounting for 80% of United States prescriptions. Among other concerning practices, critics have accused those big 3 of paying independent pharmacies lower rates than in-house pharmacies, directing business to their own subsidiaries, and pressuring independent pharmacies to accept coercive and damaging fees. I actually did a video on UnitedHealth's Department of Justice investigation a few months ago as well. Check that out for a little bit more detail on this specific point. Independent pharmacies have also raised alarms about the practice of spread pricing, when PBMs charge insurers a higher price for a drug than what they reimburse to the pharmacy and keep the difference. Of course, all 3 of these PBMs have denied the accusations. A Federal Trade Commission report published this summer found major PBMs steered patients to their own pharmacy subsidiaries instead of other local operators, including for mail-order medications and lucrative specialty drugs, and paid own pharmacies notably higher reimbursement rates, which in my view makes sense. This is their business. If you go to Apple and buy an iPhone, they're going to steer you towards Apple Care. This to me seems like a very standard business practice, but maybe I'm wrong, so please, if I am, let me know in the comments. The Patients Before Monopolies Act would prohibit a parent company of a PBM or insurer from owning a pharmacy business, according to the press release. It would empower antitrust regulators and state attorneys generals to require any companies that don't divest their pharmacies within 3 years to do so and hand over any revenue received during that period where they are in violation. That revenue will be distributed by the FTC to harmed communities, including consumers who are overcharged at PBM-owned pharmacies. Now, that's simply put a massive transfer of wealth if they don't divest per this legislation. However, the legislation itself seems to be a very large overreach. Legislation largely misses the point. However, ire against PBMs is misdirected, according to the Pharmaceutical Care Management Association, the largest lobby representing PBMs. The companies say they save payers and consumers money by leveraging their scale to force drug makers to agree to discounts, and that drug makers, which set initial list prices for medication, should be to blame for skyrocketing drug costs. And this is actually true. Drug makers set the initial list prices for all of these drugs. Like I mentioned earlier, it's to recoup the costs of that R&D, which to me is a valid reason to have higher prices. But I think there's also a lot more going on there that's way out of the scope of this video in terms of how they set prices in other countries. One thing vertical integration achieves is efficiencies at scale. PBMs steering patients to owned pharmacies could reduce the dispensing options available to consumers, according to Brookings Fieldner. However, it may be more efficient for PBMs to work with their own pharmacies, which could translate to lower costs for the payers and consumers footing the bill for these drugs. Similarly, allowing PBMs to own pharmacies provides a check against the market power of other pharmacies. I think a lot of the concern about PBMs owning their own pharmacies has been fomented by independent pharmacies who feel they're being put at a competitive disadvantage by the big PBMs. What I think is clearly true is the interests of independent pharmacies are not necessarily one and the same with consumer interests. Recent attempts at curbing PBM's business practices have fizzled out, however, and similar inertia and focus on larger priorities could lead the PBM Act to a similar fate. Remember, this is simply proposed legislation. There's a long way to go before any of this would actually become law. So this massive decrease that we've seen in the market, over 10% in the last couple of weeks for UnitedHealthcare, is a complete overreaction by the stock market. The markets are forward-looking, but they're also highly reactionary. UnitedHealth closed on Friday at $500.13, but looking at the 6-month chart here, you can see how after that earnings report in Q2, it started gaining momentum, and then it just fell off a cliff there. On December 4th, actually, right after the CEO was assassinated, but really after that legislation was introduced. I want to challenge the notion that these PBMs are highly profitable, though. This is the earnings from operations for 9 months ended September 30th, 2024. The Q3 earnings report. You see here we have UnitedHealthcare, Optum Health, Optum Insight, and Optum Rx, the 4 major players here in UnitedHealth Group's business. Total earnings from operations was $24.5 billion. Let's look at Optum Rx. Through Q3 of 2024, it's at $4.1 billion in earnings from operations, roughly 1/6 of total earnings from operations. But we're concerned about profitability, and that is going to be defined by its operating margin. What is the most profitable operation in UnitedHealth Group's business? Using the GAAP numbers, I like the GAAP numbers, UnitedHealthcare has a 5.6% operating margin. Optum Health, a 7.5% operating margin. Optum Insight, a 13.1% operating margin. Now, Optum Insight, last year, the same period, they had a 21.1% operating margin. Optum Insight was the business affected by the cybersecurity attacks earlier in 2024. That's why they're so down so far to 13.1% operating margin. They're really a much more profitable business. In fact, the most profitable business in UnitedHealth Group. What is Optum Rx? Optum Rx has a 4.2% operating margin. In fact, it drags down the operating margin for the entire Optum Group and UnitedHealthcare. UnitedHealthcare has an 8.2% operating margin as a consolidated business. So very quick back of the napkin math here says that if you eliminate the Optum Rx business from UnitedHealth Group. They have to sell it off. No more revenue, no more operating income from OptumRx. It's totally divested. The back of the napkin math says that operating margin would actually increase by about 500 basis points. So in effect, selling off OptumRx would improve margins for UnitedHealth Group. And that's what we care about as investors. We care about margin expansion. Margin expansion is what allows companies to increase return on invested capital and compound free cash flow. Margin expansion is critical to that. And honestly, selling off OptumRx would increase margins. That said, I don't think that's what's going to happen with this legislation. In fact, it is a very much wait and see game here with this. However, that does raise something else about UnitedHealth Group as a stock, and that is it introduces a certain amount of unpredictability. Once the government gets involved, it becomes unpredictable. We just don't know what's going to happen. And that's true with UnitedHealth right now. They are facing a lot of different government interventions, from DOJ investigations to this new legislation. To me, that doesn't make the stock a sell. It does make it a wait and see. That price has fallen. Has it fallen enough to make it worth a buy at this point? We'll see in a second. I mentioned before, UnitedHealth is now at $500.13 a share. Their PE ratio is at 32.6 right now, which is quite a bit above their 5 and 10-year average. But it does have a forward PE of 22.5, smack dab in the middle of their 5 and 10-year average. My bear case DCF model has it at $479.40. My year one estimate, by the way, on free cash flow margin percent is about 4.6%. By year 10 on the bear DCF, I have a free cash flow margin of about 6.2%. The base case price is at $606.78 and the bull at $770.61. The bull case assumes a free cash flow margin, by the way, by year 10 of about 7.2% and also an operating margin of about 9.25%. The dividend discount, now this is a very good dividend paying business. The dividend discount is at $544.33 on the bear case, $640.44 on the base, and $775.09 on the bull case. This assumes dividend annual growth at up to 13% and dividend perpetual growth up to about 6.75%. In a normal year, UnitedHealth's free cash flow payout ratio is less than 30%. There's a lot of room for them to grow their dividend, and they've grown their dividend by 20% annually over the last 10 years. It's a very good dividend paying company. The exit multiple is at $269.78. My comps here are Cigna, Elevance, CVS, and Humana. All of them have been facing turmoil in the markets since that legislation has been announced, bringing down their share price and along with it, the exit multiple. So best case on the bull case, we have an upside of about 30%. So right now I have a buy price without any margin of safety at $537.91, forward PE of 24.2. I typically use a 10% margin of safety with this business. However, given the unpredictability around UnitedHealth Group now, I have a 20% margin of safety. And that means a buy price of $430.33, a forward PE of 19.4. It still has to come down quite a bit more for me to consider buying back into it. In fact, this price assumes that it would have to come down below what their 52-week low is. So like I said, I don't think this is a sell, a time to panic with the stock. I think there's a lot going for this business, but I want to wait to see how things shake out. And if it comes back down in price quite a bit, maybe a bad earnings report in Q4, which should certainly send this stock barreling down, given all the negative sentiment around this stock, I would certainly want to buy more. So again, a very solid business, but a lot of issues UnitedHealth has to work through. And should it work through all of them, it should come out as a very strong, profitable investment for years to come. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.